This conference will now be recorded.
Hello and good afternoon, everyone. Welcome to our fifth session, wherein we'll be talking about trading strategies. But before that, as always, I would request you to give me a couple of confirmations for the AV. The audio and the video should be okay today afternoon. Shouldn't have any issues. Good afternoon. All good then. Thank you, Pawan, Sarup, everyone. Very happy New Year to you too. So we started our journey last year, and we are in a new year now with a very important session today, wherein we'll be talking about trading strategies. Tomorrow, we will extend this. We'll do a quick revision. We'll talk about money management and, of course, trading mentality. And on Tuesday, we have a practical session wherein I will show you how one should approach trading during real-time live markets, implementing whatever we have learned in our sessions, right? So without much wasting of time, let's move ahead. Just a quick disclaimer. There's a little weird kind of a noise which is happening on the top floor above me. Generally, these things are not allowed after 2 o'clock in the afternoon. If it happens, like I think it happened with us in our first class, I think so, was this batch. If it happens, it'll happen once or twice. I'll put myself in mute, and once it stops, I'll resume again. Okay. So trading strategies. Now, trading strategies can be price based. The way I look at this, okay, it can also be time based or time defined by time. When you're defining it by time, what do you know? You know there's something called intra-day trades. Intraday trades are the ones where you enter and you exit on the same day. You don't have any overnight risk. You don't carry forward any position. It has its pros and cons. You can take a larger position with a small amount of money because intraday trades allow you to take maximum use of your margin. You don't have any overnight risk, so whatever happens tomorrow morning, gap up, gap down, it doesn't bother you. If the index is at 7,000 or the Nifty is at 14,000, it also doesn't bother you. because for you, how it's going to open tomorrow and how it's going to close, and between that, your journey. That's it. You live for the day. You hunt for the day. Downside, of course, if there's some kind of a big move tomorrow in the opening, then of course you get missed out on those big moves. Those big moves need not necessarily be always against you. Those big moves can also and does also happen for you. So time-based, primarily we hear this thing intraday, and which is not in intraday, we essentially call it positional trades. Positional trades are the ones which are positional in nature, means you have taken delivery, you've taken it back home, you want to hold it overnight or for a week or a month or a year or a decade, because you want to ride it longer, you want to ride the trend longer for a longer space of time. Again, need not necessarily be the fact that you're riding it for a longer space of time means you're profitable. In fact, most of the investors, if you ask them what are the stocks they're holding for a long period of time, I would probably say that 90% of their holdings will be the ones which have gone wrong, and they're still holding on to it. And that's positional trades. Price-based or structure-based. Okay, looking at the structure of the chart or looking at the price, and price not in absolute terms but price in relative terms to its recent behavior, is structure based. So what we are looking at is in terms of the structure of the chart. So let's say if you have a chart and we know that prices trend up, we know that prices also go through consolidations, they can continue the trend, and we also know that there is always a reversal, and there is these three primary movements: uptrend, downtrend, and sideways trend. Now, based on the structure of the chart, where are you right now? Are you here where you were like 3-4 months up here, or 3-4 months before that where you were in some kind of this phase? Now, in this kind of a market, it's in an uptrend with a short-term correction. At this point of time, it's in an uptrend at the peak. This is a downtrend where it's trying to bottom out. So the nature of the market, the nature of the price setup changes over a period of time. If you recall, when we spoke about the difference between a stock and a company, we took the example of Reliance Industries. And if you remember that the Reliance went from 70 to 700 in a span of 4 years, whereas it stayed in the same price for a span of 7 years. The same company, the same stock of that company, but the nature had changed. The dynamism has completely changed. The paradigm has changed. And so depending on this paradigm, depending on this setup, depending on the structure of the chart, there can be certain price-based, structure-based approaches. You can have all the approach, or you can have only one approach. Let's try and understand. And these are completely my perspective, all right? So the way I look into it, when I look at a chart, I would like to ask such certain questions based on the structure. Based on the structure, I feel that we can have breakout trades. We can have contrarian trades. And then we can have swing trades opportunity. Now, the way I define swing trades is very, very unconventional compared to what you will find over the internet. If you search for swing trading and the definitions that you'll find in websites like Investopedia, etc. So swing trading conventionally people understand is a short-term trade for 1 to 5 days. But that's not how I define swing. I define swing not in terms of time, but in terms of the swing of the price or the movement of the price. The definition of swing from my side is as per price and not as per time. So let's look into these three one by one. Breakout is the most simplest and easiest one to do. As the name suggests, very clearly, very simple, break out. So breaking out means prices are stuck in some kind of a range or some kind of a consolidation, and from there it is about to break out. So let's say, for example, if you recall the day we did some patterns, let's say the symmetrical pattern or the pennant pattern or the wedge pattern that we did. Okay, what was happening to the price? The prices were within that particular consolidation, some kind of a range it had created. And from that range, it was either breaking out on the upside or it was breaking out on the downside. So if you're trading patterns, if you've based your trades on basis of these pattern breakouts, then you're essentially a breakout trader. Breakout trader need not always be based on patterns. For example, you look at a chart and you find that the chart is in a nice uptrend, but it's finding a clear sign of resistance at a certain price level over and over again. You check once, twice, and 3-4 times. It's just not able to break this level. But the trend is strong, the market momentum is strong, the sentiment is strong, and about time it breaks out. So if you buy here, you're a breakout trader. So irrespective of the pattern or no pattern, what a breakout trader does is you buy high. You are always buying a rising market. When the market is running away, when the market is gaining on the upside, it's a rising market. That is when you buy. You buy high with the anticipation that you will be able to sell higher. So let's say on Monday, if the price was, let's say, at 100 rupees, and then it went up a little bit like this, and on Thursday or Friday, let's say it is at 105, and you're buying at 105, your friend might ask you, why didn't you buy on Monday when it was 5 rupees cheaper? But then you'll say, no, listen, I'm a breakout trader. I don't buy cheap. I only buy when the prices start to move, when the prices start to show momentum. And I don't hesitate to pay 5 rupees extra, because this 5 rupees that I'm paying extra is for the confirmation, okay, this guy is showing signs of movement. And this movement can take me to 510, 15, or 20. So I'm a breakout trader. I will always buy high, always relatively high, with the anticipation that I will sell higher. A breakout trader on the downside will always sell low, always. It will always sell a stock which is falling with the anticipation that he will cover it later at a lower price. So if you hear about stocks or about systems which buy at a 52-week high, when the stock goes at a 52-week high, there are few traders who buy them. Now you'll find it very, like many other people will find it very illogical. Why will I buy a stock which is at its yearly high, rolling yearly high? It's the highest point of 52 weeks. So the logic of breakout traders is buy strength, or in other words, we buy strength and we sell weakness. This is the philosophy of breakout trader. You cannot do anything about it. It's just that you have to, if breakout trading suits you, you accept this. This is who you are. This is your nature. Now the downside or the other aspects of breakout trading is very poor strike rate. Any breakout system, if you trade, you'll find a very poor strike rate. A poor strike rate means you'll have maybe 30 to 40% of your trades going in your favor. Out of 10 trades, 3 trades will be right, 7 trades will be wrong. You will end up making large number of smaller losses and small number of large profits. Your profitable trades will be less, size of the profits will be large. Your number of loss-making trades will be more losses, but the size of those losses will be small. So if you take 10 trades, if you have done 10 trades and 7 have gone wrong, and let's say you have lost 1, 1, 1, 1, 1, 1, 1, then you're down -7, right? But in the next 3 trades, or whatever the 3 trades which you have gone right, if you have gone right, let's say 3, 2, and 4, then you're +9. So net, you're +2, you're 20% up. Not 20% up, I'm sorry, this is strike rate. So this is one big thing about breakout traders or trend following systems. If you try to fix this, if you try to make a breakout system better strike rate wise, your profitability will drop. You cannot do anything about it, trust me. It's just the philosophy that you have to focus on. Are you comfortable with this philosophy? All are not, and that is completely okay. Everyone does not like to eat Chinese food, and neither does everyone likes to eat pav bhaji. Just the fact that you like to eat pav bhaji does not mean that everyone will love that. It's just your nature, our tendencies, our beliefs, and when we exercise these beliefs for a certain amount of time, the belief becomes stronger. So we'll look into examples of how we can do breakout trades, but this is what a breakout trade is all about. Contrarian trade is the very, very opposite. Contrarian trader looks for the market to top out. He will sell a rising market and he will buy a falling market. So you can say that the other side of the trade, when a breakout trader is buying at 52-week high, then who is selling to him? The contrarian trader is selling to him. When someone buys at 52-week high, he or she feels that this stock is going to go much higher. This stock is showing strength. It will go much higher, so I buy. The person who's selling it to him feels or believes or thinks that it's not going to go any further up. It has gone up significantly. Now it's time for it to come down, and that's why he's selling. So the contrarian mindset and the breakout trend following mindset is just the opposite. They are the other sides of the coin. So if the Nifty is at 14,000 right now, it's an all-time high. It's gone up significantly over the last 9 months. If someone is selling Nifty at this price of 14K, you know he's a contrarian trader. However, in March 23rd, when Nifty was significantly lower, and if someone was willing to buy Nifty at that point of time, then he's a contrarian. Let's look into a chart and let's understand this. I will, let's say, take up a trend trading view to start off with, and then I'll take you to Spider Software with the queries later on. Let me take up any chart, let's say State Bank. So let's open a fresh chart, something like this. Okay. Let me take a screenshot. Let me copy this. Come here. Paste it. Okay, so this is the daily chart of what? Escorts. Okay, that's okay, it doesn't matter. So let's understand few things. Let's understand when is a breakout trader playing out. So a breakout trader would be buying somewhere here. A breakout trader will be buying somewhere here. A contrarian trader will be buying somewhere here. Now prices have come down. Okay, let's say the other side. A contrarian seller, if someone is selling at this price, this is a contrarian seller. So you get the picture? The picture is, are you buying strength or are you buying weakness? If you're buying strength, you're buying with the flow of the market, you're probably a breakout trader. You're buying a falling market, you're buying weakness. Price falling is a sign of weakness. Price rise is a sign of strength. If you're buying weakness, then you're a contrarian trader. A contrarian trader thinks that prices will not fall any further from here and we should buy. A contrarian trader thinks that prices will not go further up from this price point and it should fall. Breakout is just waiting. Breakout trader waits for the price to show strength. Now the third is a swing. Swing is the way I structured it, or the way I look into it, is making the use of a bit of both. Means the swing trader will never go against the flow of the market. So a swing trader is definitely not a contrarian trader. So in this case, if you look at this particular chart of Escorts, we can find that Escorts in this phase was in a well-defined uptrend. And in this well-defined uptrend, it went through multiple phases of short-term corrections. So in a well-defined uptrend, whenever the stock goes through a short-term correction, and if you're participating in this, trying to buy in this is a swing trade. So buy on a dip or sell on a rise. That's the swing trader. The swing trader will first figure out what is the underlying trend of the market, of the chart. If the underlying trend of the chart is positive, then he or she would always look to buy. But he or she will not buy a breakout. He or she will not buy when the price hits a new high. They will patiently wait for a short-term correction, a short-term opposite movement of the long-term trend. If the long-term trend is up, wait for a short-term drop in price. If the long-term trend is down, then wait for a short-term rise in price, and then you initiate. That's swing trades. Sell on a rise. The main trend is down. On the other hand, buy on a dip when the prices fall. So most important thing for a swing trade is the existence of a previous trend, because the stronger the trend, the easier will be to do swing trades. For contrarian and swing, it's very important that there is a strong trend. When you look at breakout trades, breakouts can be continuation of the previous trend or the revival or the start of a new trend. So these are the three ways structurally that we can look into any chart now, any chart that we open up now going forward. We will be able to figure out whether the chart provides us, allows us to do any kind of such trades or not. Does it allow us a contrarian trade? Can we do a breakout trade in these circumstances? Or should we wait for a swing trade? At times, we may not have any clear-cut answer. That's okay. We have to patiently wait for the trade setup to shape up. Okay. Now, with this understanding, we will do, or I will show you an approach. We'll start off with swing, then we'll do contrarian. It will be an approach. We'll understand the approach. We'll create templates based on that approach. We'll see visually on the charts how it looks like. We'll try and create scans on the Spider software so that the software gives us the possible trading ideas, the possible stocks that we can trade on. And this is what we have in store for today's session. Extremely important. What we are trying to do is create a high probability setup. Means you don't keep on hitting the iron every day. You don't keep on out of compulsion or impulsively keep on trading randomly each and every day. That Monday when the market opens, whichever stock is trading at whatever price, okay, this stock is going up, let's buy. Okay, this price is falling, let's sell. Or okay, Reliance is coming down, let's buy. Okay, IDC is going up, let's sell. That's random, without any rationale, without any logic. Now what we are trying to do is bring some intelligence in this approach of trading. What we're trying to do is create some edge, some high probability setup. That let's say we find a chart of Escorts which is in a strong uptrend, and over the last 2-3 weeks it has come down, and now because it's come down, it will probably try and bounce back, and I want to make money in that bounce back. It has a high probability of bouncing back, and I want to monetize that bounce back. There is a certain logic in this. There is a certain rationale in this, and we'll try to make money through these rationales. These are trading setups. There can be millions of trading setups, and there are various different types of beliefs. I'm going to like we did indicators, like categorized, and then similarly I've categorized it for you: a breakout, a contrarian, and a swing. And now I'm going to show you how you can do that, right? So let's start off with swing. But before that, I'll quickly check your questions. Is it right to buy a long straddle for weekly options if the volatility of the market is low? You can do that. No audio. Sir, if price breaks a trend line, that doesn't necessarily mean that price changed the trend. No, that doesn't necessarily mean that. That doesn't necessarily mean that. Because the trend line that you have drawn, the trend line which is there on the chart, what is the guarantee that after breaking it, it will not bounce back again? How can you say that this is the trend line? It is a subjective line, y equal to mx plus c, a straight line that you have drawn on the charts. So you cannot say that. Okay. Now let's move on and let's talk about the first strategy. Okay. Breakout strategy, we have to a lot of extent already covered when we did Heiken Ashi. If you remember Heiken Ashi trading strategy, what did we do? We found a trend and we found a reason to follow the trend, right? We found a stock which gave us a breakout. So breakout trades can also be, to some extent, categorized as trend following strategies. But what we will focus now first is swing. Now, I predominantly like this kind of setup, the swing setup, number one. Now, don't go by my words. Don't go by my words. Understand this concept. Implement the concept on your charts. Visualize it. Shadow practice it. Paper trade it. Backtest it visually on any stock n number of times, and then slowly you'll get a good confidence or grip on that. Now, personally, I have had the maximum consistency with the swing trades, and out of my own personal experience, the suggestions, feedback, whatever I have had over the last decade or so in terms of trades done by people who have learned from me, most of the, I would say 99% of the successes have primarily come from this approach, the swing approach, primarily. Now, what are we trying to do in this swing approach? First, find a stock which is in a strong uptrend, or find a stock which is in a strong downtrend. We can do this. We have already done the triple exponential moving average method, which gives us the positive order of a chart and the negative order of a chart. So whenever the 13 exponential moving average is greater than 21, is greater than 34, we concluded that we are in a positive order or a positive trend. Similarly, 13 is less than 21 is less than 34 exponential moving average. And when we saw this, when we find this, we conclude that it's in a negative order or it's in a downtrend. Done. So let's come here. Let me just connect with the team viewer with the Spider software, because we will be creating scans on that as well. Just give me a minute. I'll just connect with my desktop. Okay, so over here I go to average, short, medium, long, short, medium, long. No, Aditya, you did not do anything. Do not open your, means if you do this, do not compromise on understanding the concept. In a hurry to replicate what I'm doing at my end, do not compromise on the understanding. You can better off listen to me, watch my screen, understand clearly as much as possible, then re-watch the video and you'll have enough time to replicate it at your end. Okay, so I come short, medium, long, exponential 13, exponential 21, exponential 34. Let's keep it RGB, R, G, and B, and let's plot it. So let's open a price watch of the Nifty 50 stocks, should we? So let's say Bajaj Auto, from this point onwards, the order is positive. You'll agree? The order is positive. And so we will be looking to buy only in short-term corrections. When were those short-term corrections? This was a short-term correction. uptrend, correction, bounce back. Let's look at Bajaj Finance, uptrend, correction, bounce back. Look at Coal India, uptrend, bounce back, correction, bounce back. So we are interested in the stocks first, which are in an uptrend. So which are in an uptrend or a downtrend is now clearly defined. There should be no doubt in our mind what is an uptrend or a downtrend. Okay, now that we know an uptrend, now the important thing is, how do we figure out when the stock has gone through a short-term correction? This stage, this stage, this stage, that is, the stock is bouncing back. It's a short-term bounce back in a long-term correction. How do we do this? For this, or short-term momentum, we will call this short-term momentum. And for short-term momentum, there are a couple of ways. I will use the relative strength index 3 period. You plot a 3 period relative strength index. Take the 75 as the overbought and take the 25 as the oversold. Let's plot them on the charts. So I come here and you go to relative strength index. You come to parameter, take it 3 period. We don't need the average of the RSI, so I have taken it 3E1. This one is the average of the RSI. The average of the RSI is not required, it's not needed. So I have made it 1. Subgraph. Overbought and oversold, change it to 75 and 25. Added. So look, let me hide the price. So your criteria is it should be in a positive order. We can clearly see it's in a positive order. Second criteria is within a positive order. When the order is positive, you want situations where RSI 3 has fallen below 25. This is the instance, this is the state where it is suggesting that, listen, it's in a positive order and now prices in a short term has come down. There can be two possibilities. After coming down, it can resume going up or it can continue to fall. There can be these two possibilities. Now, the chance that we are going to take as swing traders is this one. The chance we are going to take is based on the trend that it is easier for the trend to continue than to reverse. And if the order is positive, the trend is strong and positive, and then if it has given us a short-term correction, then the chances are a little higher. The chances are a little better that it will continue rather than reverse. And so with this belief, with this understanding, now we look at the candles and we see that yes, at this juncture, at this price, it was oversold. At this price, it was oversold. At this price, it was oversold. And at this price, recently, it was oversold. You will notice in this particular example, where we have it, in the 4 cases, this was the first case, which led to a bounce back. This was the second case, which also led to a bounce back. This was the third case. This was the third case, which did not lead to any significant bounce back. This was the fourth case, which has now given us a bounce back. So in this, since this point till now, August, September, October, November, December, in 5 months, if a particular chart gives you 4 possibilities, out of which 3 goes pretty good, then there is definitely an edge. There is definitely some intelligence. There is definite some structural viability, the basis of which you are basing your trades. The rationale is quite sensible. It's quite logical. It's got some merit in it. This is swing trading. Now, how can we do this? So 2 steps we have understood. Step number 1 we have understood is how to find the uptrends and the downtrends. Let's stick to uptrends. Let's stick to long trades because it will be easier for all of us to understand if we talk in terms of long trade, because I know everyone is not into futures and options and everyone is not into derivatives, and many people still do not understand how can you sell and make money, because the conventional theory of buy and sell is something everyone believes in. So let's stick to the long trades. So for a long trade, this strategy I call aim and shoot. Aim and shoot has various variations. Over the period of last few years, I have found various ways in which I can do an aim and shoot trade. So let's talk about a long trade. For a long trade, you need an uptrend, right? So either we are calling it an uptrend or we call it a positive order. They both mean the same. And how do we find this? We just discussed this some time back. 13 EMA greater than 21 EMA greater than 34 EMA. Next thing that you need for a long trade is short-term momentum. Because it's a long trade, you want momentum to be oversold. You want the market to have done the opposite of the long term. The long term trend is up, so the short term trend should be down, or it should be oversold. So for this, all that you need is a 3-period RSI, the value of which should be below 25. Okay, till this point, it's when you have both of this, it gives you a setup, a possibility. So far, this is a possibility, not a trade yet. The next part is the shoot. When do you shoot? Shoot is the trigger based on which you buy. Shoot is the trigger. Now that I've got a positive orderly market, and in that I have got a short-term oversold condition. So if you go back to the chart which we were looking at here, let's say we come to the first instance, which was here. This is an aim. This is where I'm aiming it. I've not bought it yet. I've not participated. I've not bought yet. This is an aim. This over here is an aim, because in a positively ordered market, the markets come down below 25. So this is an aim. Now I want to shoot. Now you give me a confirmation that yes, the markets are going to go up. For the shoot, there are few ways, but the conventional way that we've been following for some time is using the stochastics indicator. I'll show it to you now. Use of the stochastics indicator 432, giving us a positive cross. All this I will explain to you step by step. Don't worry. Let's come here. And let's bring in the stochastics indicator. Stochastics indicator, if you look here, it is made up of 2 lines called %K and %D. Percentage K is the number of days or the range of days which you want to consider. For example, if percentage K is equal to 4, this means we are interested in the range, high-low range of last 4 days, which means if this is day 1, if this is day 1, this is day 2, this is day 3, and let's say this is day 4. Okay, then in this 4 days, which is the lowest point, which is the highest point? This is the 4-day range. All right, now in this 4-day range, now if I ask you, where is the current closing price? This is the CMP, current closing price. So if you look at the range of last 4 days and you find out where is the CMP, where have I closed now? Have I closed in the upper quadrant or have I closed in the lower quadrant? If I break the range in 2 parts, if I take halfway, midway of the range, then currently where am I? Am I towards the upper range or am I towards the lower range? If I am towards the upper range, it's a bullish sign. If I have closed on the lower edge range, it's a bearish sign. This is the logic of the stochastics indicator developed by George Lane. So what he did, number 1, first you take up a parameter, the number of days that you want to consider, 4, 5, 10, 15, 20, whichever range you want to consider. This gives an indicator called percentage K. Percentage K is very, very volatile. It jumps up and down a lot. And so it goes through a smoothing process. It is smoothed out by taking an average of 3 periods. So a 3 period simple moving average of percentage K is calculated to slow out the percentage K, which is called the slow percentage K. After this, a 3 period simple moving average of this percentage K is taken to get percentage D. All this mathematics leads us to what? Let's see. All this mathematics leads us to an indicator which looks like this. This is the stochastics indicator. You will see there are 2 lines. One is called the percentage K, the other one is called the percentage D. One is called the percentage K, the other one is called the percentage D. Which one is which? If you look at it little closely, you'll find that over here in blue, this blue line is crisscrossing the red line. One line needs to cut the other. Which line is that? You will always find that the blue is cutting the red from below or from above. It is the blue which is faster than the red. The red is slower, the blue is faster. Whichever is the faster is percentage K, whichever is slower is percentage D. Okay. It has an overbought, oversold conditions territory of 80 and 20. 20 is oversold, 80 is overbought. But we are only interested, where are we stuck? We are stuck in the shoot. When do we know, when can we confirm that yes, this is the time to buy? For this, all that we are doing now is using the stochastics indicator. And when the stochastics indicator gives us a positive shoot, this is a buy shoot. This is a sign of strength, cutting from below. If this happens in the oversold territory, better, cutting from below. This is a sign of buying, sign of strength that the markets are trying to go up. This is what we will call as a positive shoot. On the other hand, when percentage K cuts the percentage D from above, that is dropping from above like this, and like this, these are signs of weakness. This is a negative shoot. Let's understand this with the help of the Grasim chart, which is open behind us. It's the same Grasim chart we're talking about. Where did you get the first aim? Here. On this day. And the very next day, it gave you a shoot. Do you see this? Aim and shoot. Aim and shoot. If you want me to zoom in, look at this red candlestick that we have here. It coincides with the RSI 3 dropping below 25. On the close of this day, you and I will be able to say, listen, the Grasim chart was in an uptrend, positive orders for some time. And now recently, over the last 4 days, it has corrected from 750 down to 680. If this is a short-term correction, then eventually prices will go up. And if prices go up, I want to benefit from that rise up. So now I've got an aim. I'm aiming this stock, but I'm not going to buy a falling stock. I want confirmation, some signal, some sign that yes, it's a revival, it's a reversal. And so I wait for shoot. Shoot, if you look at down here, the stochastics that we have plotted, the very next day, it has given us a shoot. The blue line has gone above the red line. Percentage K has gone above percentage D. Are you able to see my chart? Because at my end, it has kind of frozen. Okay. Okay, just give me 1 second. I'll just stop sharing my screen and share again. That will solve the issue. Not really. Anyways, it's still stuck at my end. Nevertheless, I will continue because you can see it. So this was the aim. This was the shoot. Okay. Now with this objective, with this understanding, then what we can do is we can buy above the high of the bar, and the recent low we can keep a stop loss. We will today focus only on entries. We will completely focus today on entries, how to enter a chart well, a stock well. Targets, exit is something we will discuss tomorrow at length. Today's focus is entry. So if you have this question back of your mind, now that I know how to enter, where should I exit, when should I book my profits, how should I trail my stop losses, and all these concepts we will take up in detail tomorrow. Today's point of focus is only entry. Okay, one by one, one at a time. So this gives us, so this has given us an aim and shoot. The next time RSI dropped below 25 was here, this small red bar. Can you see this small red bar? Because at my end it's stuck. I need to understand if you can see this small red bar. No, sir. Okay, that I thought so. Stuck. Yes, it is stuck. Okay, so what I'll do, I'm going to, maybe this is not an issue with any of our internet, it is an issue with TeamViewer. So I will close the TeamViewer and I'll restart it again. As I restart it, I hope you've understood the concept. The concept is we find a chart which is beautifully trending up or down. Okay, that's very important. This is very, very important that it needs to trend up or down really well. Yeah, now it's fixed. Now the second instance in the chart of Grasim was here, where I've kept my cursor, this red bar, this small red bar. This is my aim bar. This is where, from the point I am interested. Why? Because very clearly I can see that the order is positive, goes through a short-term correction. This short-term correction has led the short-term momentum indicator to go oversold. Now two things can happen. Either it will revive or it will continue to go down. How can I sense some degree of revival? The moment I get a shoot, positive shoot, a crossover, which comes on the, let me check, which comes on the very next day. So we buy, use the recent lows as a stop loss. This is my point of entry. Again, I will repeat again, today's focus is only on entry. Right? So next, let's move ahead and look at the next instance. The next instance was here. 4-day correction. Stock comes down to 23. It's an aim. Next day, it's a shoot. We will be looking to buy above this. The price does not go above this. Next day, prices comes down a little bit. Do we still have a shoot? Do we still have a shoot condition? Yes. You look down here. Percentage K is above percentage D. The positivity from this indicator is still intact. So we buy above this, low as a stop loss, gets triggered, goes up a little bit, then further marginally up, but next to next day, it gets stopped out. We are out of the stock. Then as it falls for another 3 days, it creates another aim, another opportunity. And the next day, it gives us a shoot, this one. So we buy above this, low as a stop loss. Triggers, gives us an immediate movement, slows down for 2 days, and then further movement. This is an aim and shoot trade. The aim and shoot trade on the opposite side is when you look for a downtrending situation, a bounce back which takes the RSI above 75, and then after that it drops down. Sell below this red bar, high as a stop loss. This is an aim and shoot on the downside. So you get the idea. The essence is, first and foremost, find a well-defined, beautiful up order or a down order. The more beautiful, stronger the order, most of your work is done. Because most of the work is done in finding the good orderly trend. Once we have found that, we want a short-term correction. And based on the short-term correction, we will take a trade. This is a beautiful orderly downtrending market. This is where it gives an opportunity as aim. Next bar, it gives an opportunity to sell. This is aim and shoot. Can we scan this on the Iris Plus software? Yes, we can. I will show you now step by step, but before that, I'm going to quickly check if you have any questions. Time frame, I am using the daily chart. Now your next question will be, can this be used in any time frame? The answer is yes. Is this called diversion, positive or negative? No, it is not. Is this stochastics RSI, Aditya? No, this is simple stochastics. There will be no requirement per se to use stochastics RSI. We will not be using stochastics RSI at all. So this is just simple stochastics. In simple language, whenever blue cuts the red line from below, it's a buy signal and vice versa. That's right. Exactly right. Does this mean stochastics is a lagging indicator? Not necessarily. Stochastics is a leading indicator. It considers momentum. How does it consider momentum? By figuring it out, this logic of where have I closed compared to the range of the days. Okay. So it is essentially, to a lot of extent, a leading indicator. How do we find this kind of chart? So I will now show you how you can find this kind of chart. Time frame you suggest for this strategy. For any strategy, I would suggest the daily time frame. The daily charts has the maximum potential, is what I feel. It is my belief. This does not necessarily mean that this setup or any other setup, you will not find it in the 15-minute chart or the 75-minute chart or the 60-minute chart. You'll find it in all time frames. Okay. Now, this is what I will suggest and request. Once you understand these strategies and before you implement them, there should be some practice, a clear-cut, thorough understanding, a definite amount of practice so that you come across various combinations. Because understand one thing, each and every aim and shoot trade will be very, very unique in itself. Aim and shoot setup are not going to be the same. They're going to be different. And so you should be ready to expose yourself. You should be looking into as many combinations as possible. The more combinations you look into would be easier for you to get a sense of it. So there should be a certain degree of practice. When you practice it, you'll get better at it. Okay. So I'll show you. So whatever I'm plotting here is on the daily charts. Aim and shoot name is given by your own definition. Yes, I have given this name. Can this be used in options? Aditya, yes. If you find a positive aim and shoot, you can execute that in options also, provided you understand the intricacies of the options market, provided you understand whether you're buying an option or selling an option or setting up a strategy. So all those understanding you need to have yourself. My one doubt is that all indicators are based upon price. So why do we use indicators? That's right. It's like fried rice and biryani and khichdi. All of them are made up of rice, but then their preparation is different. So RSI is created out of price. So is stochastics created out of price, and so are the moving averages created out of price. But if you understand and if you look at the chart, the purpose that moving average is serving us is very different from the purpose that RSI is serving us, from the purpose what the stochastics is trying to serve us. So you're 100% right when we say that they are all derived from price, but the way we have utilized it is different. Okay. Akhilesh's question is missed out. That's not fair. Let me find out where your questions. If you have posted it down below, it will be good for me. Okay, suppose I buy call and our strategy does give an uptrend and price follows, but it happens after my expiry, I will lose. So Akhilesh, that's exactly what I was answering to Aditya, saying that you can definitely execute this in the options market, provided you understand the intricacies of the options market. Are you buying or selling? Which strike price are you taking? What are the IVs? How far is the expiry? If you understand all these concepts of the options market, then of course you will be able to execute them. Having said this, I am just going to take one small example. It will be a little detour. You probably would know that I have a community of traders and we trade. It's a program, it's a lifelong program, and we discuss all our hits and misses and all those things. And in our community, I have interacted with few option traders. They only trade options. So what they do is they find the probabilistic direction, the directional clarity from the strategy. Let's say Grasim is likely to go up. And if Grasim is likely to go up, then based on that, either you buy a call. If you're buying a call, if you're an option buyer, it's always good you stick to ATM or ITM. Okay, do not go for OTMs. So these few things you have to keep in mind. Why we should not depend on indicators, sir? Why we should not depend on indicators? Dependence, I don't know whether that will be the right word or not. I would say usage. Indicators are to be used. We are using 3 moving averages for what? To give us a proper trend. We are using RSI for what? To give us a short-term momentum overbought, oversold. We are using stochastics here for what? To confirm that, okay, the prices probably will now try to go up or come down. So are we depending on them? Maybe not. We are using as a combination to create a logical trading system, a logical trading approach, and not trading randomly. What's the difference between modified RSI and RSI? Modified RSI, Bodhisattva, would be something like a smoothened out RSI. A lot of people have done a lot of work on all these indicators by calculating smoothed indicators, by trying to curve fit it, by trying to make it better and better, but it doesn't work that way all the time. So what should I do? Should I hold the futures only or long calls? Akhilesh, that depends, right? Exactly what I was explaining. If you are in the futures, if you've bought, let's say, the near month futures, and after 3 days there's an expiry, then you roll over. Then of course you understand the concept of rollover. I assume so. You roll over as long as it's fine, right? If you do options, then you have to keep that in mind. How far is your option expiry? If it's after 2 days, then it doesn't make sense to buy, right? You would rather sell options. And that's why I said, get the direction clarity from the strategy, execute it in your way. For example, if you're an option trader, you can execute in options. If you're a futures trader, you can execute in futures. If you're a cash market trader, you can buy it in the cash market. Okay. Why do some investors sell deep in the money puts or deep out of the money calls? What happens is when you have a large portfolio and you will not be selling the portfolio, with the bull market, with the equity markets going up, the prices, your portfolio will continue to go up and make money. And so what you will do is you will sell deep out of the calls. This is called covered call, a very, very simple strategy. Okay. You would like to sell puts. Who would like to sell puts, bullish or bearish? Okay, Warren Buffett does that. I don't know Warren Buffett does that or not, but we need to understand that a very simple way is a covered call. Famous investors or any HNI investor who will have a decent portfolio of 1,000, 2,000, 5,000, 10,000 Reliance would always love to sell out of the money calls and pocket in the premium. If they go wrong, if Reliance goes up, it's anyways fine because they are making money with their portfolio going up. So Akhilesh is regularly doing that, so it works for him. Okay. Let's move ahead a little more, and now let me show you how we can figure it out on the software. Out of, let's say, 200 stocks or 500 stocks, how do we know which stock is satisfying an aim and shoot long possibility for next week? This is where the technical query comes into the picture. I think I have shared this technical query box before when we spoke about, I think, the candlestick patterns. I have repeatedly requested you to go through the YouTube playlist, wherein in the last video of the playlist, there is a dedicated video on technical query, how these queries can be created. Nevertheless, let me show this to you step-by-step manner, how you can create an aim and shoot long setup on the technical query section here. So technical query is made up of many conditions and some area which is called relationships. I will come to condition number 0. Condition number 0. I double click condition number 0 and I go to average short long. Average short long. I select average short long. I go to parameter exponential 13, exponential 21. Let's keep it on the daily time frame. I come to condition and say above average for the last n bars. That is 13 is above 21 for the last n number of bars, and the value of n is over here 1, which means 13 is above 21 for at least 1 day. It can be 50 days or 100 days, but at least 1 day. Add. Come to the next condition, condition number 1, double click, average short long again. Go to parameters. This time choose E21 and E34 on the same time frame daily. And then go to condition and say above average for the last n bars, the same thing, no change. And then you add. So now if you look at the two conditions, condition number 0 reads 13 is above 21. And condition number 1 reads 21 is above 34. 13 above 21, 21 above 34. Can't we not do this in one shot? No. If you come to average short, medium, long, there are no such condition which allows us to mention that aspect. As of now, Spider has not allowed us, and that's why we broke it down into two parts. The first part is 13 above 21. The second part is 21 above 34. Now I come down here to relationship. And in relationship, I type C0. C0 stands for condition number 0. AND C1. C0 and C1. Condition number 0 and condition number 1 together. I make sure that condition over here in the middle is clicked and I check on this box. So few things. Conditions are created here. We have to make sure that the relationship is clicked here. The relationship is created with a checked box where I've typed C0 and C1. Then you select a group here. Over here already the futures near month contracts are selected, around 139.40 stocks. You can change the group from here. And once all of it is done, you can hit run and it will scan all the stocks in just few seconds, and it will show you those stocks which are in an uptrend. Uptrend, not aim and shoot. We just have two conditions, 13 above 21, 13 above 21 and 21 above 34. That's all that we have asked the software as of now. So out of 139, 126 scripts are fulfilling our conditions. Of course, it's a strong bull market, so it will satisfy. Now let's come to the next part. The next part is you go to relative strength index, RSI, and you go to parameters 3E1 on the same daily time frame. You go to condition and you say below the value of 25 and you add. Now you got a new condition which is named C2. So you come down here to relationship and now you say AND C2. C1, C0, C1 and C2. Show me those stocks which are in an uptrend, those stocks which have come down recently so that RSI 3 has dropped below the value of 25. Run. Bajaj Finserv is the only stock which satisfies our condition. It is in an uptrend. It has been coming down for some time. And yes, the RSI 3 has dropped below 25. It's at 17. It's at 22 right now. It's a strong bull market. So of course, the number of stocks has come very, very limited. If you allow me, I can change this group to a slightly more larger universe, something like Nifty 500, and run it, scan it on the 500 stocks just to find some extra names. Yes, Gillette, JSW Energy, and SIS. I do not track cash market stocks at all. I'm completely into the futures market, so not aware of SIS at all. JSW Energy, yes. Gillette, yes, I understand. So if you look at JSW Energy, is it in an orderly market? Yes. Has it been coming down? Indeed. And this coming down is now defined by RSI 3 dropping below 25. This state of JSW, this state of Bajaj Finserv is an aim state. It's aim, not shoot yet. We picked up the gun, we've aimed so far, we've not shot yet. The shoot will come from the crossover down here. So there are two ways to do this. You can keep a note of these 4 stocks in your radar and you keep tracking them. This is a daily chart, so you have to track them end of the day. And you track them, when do you get the crossover? When does the shoot indicator confirms you a buy? And that is when you act upon it. This is preparation. There is one way. This is one way. The other way is the reverse way. That is, I do not scan for aim. I remove the RSI 3 criteria. I remove it. And in place of RSI 3, I scan for shoot. I do not scan for aim. I scan for shoot. So I come to stochastics. I change the parameter to 4, 3, and 2. 4, 3, 2. Remember this, 4, 3, 2 on the same time frame as daily. And give a condition that cutting average upward, percentage K is cutting percentage D upward, which is a bullish cut, which is a bullish crossover. Add it. Now my C0, C1, C2 is uptrend and crossover, not aim, not aim. And if I run this, I now get a lot of strips. 166 strips is too much in the Nifty 500. Now I've got 139 strips. That's also very, very high. Okay, there is a way to filter it out. So let's do one by one. So what have we got? Let's say we take up CanBank, this example. Is it in an orderly market? Yes. Has it given a positive crossover? Yes. But do we want this kind of setup? Of course not. What do we want? What we want is this indicator to come down here. This indicator will be down somewhere here, and then it will give me a cut. This is what we want, right? Not this. This is just wasting my time. So one way that we can do this is you come to the strategy and you take up stochastics 432 again, and you give a condition that below, let's say 40, percentage D should be below 40, which means that the indicator values should be close to oversold. I'm not giving 20. You know why? Because every time the crossover need not come from 20 or sub 20. So I'm giving something like 40. So below 40. If I add this, and if I add this here, say and C3, and now if I run, now you see I get only Biocon, Coal India, Cummins, Nestle, and NTPC. Now only 5 stocks. Of course, you and I can check. But this is not complete. This is not complete. Why? Because when I click on Biocon, I get a positive order. I get a positive shoot. But remember, the name of the strategy is aim and shoot. Do we have an aim? Do we have an aim here? Has the RSI gone below 25? This is something that you have to check manually. Over here, in this case, specifically, the value of the RSI has come down to 30. And then it is giving me a shoot here. So it's not an aim and shoot per se. Coal India, the aim came down here. And the first aim and shoot was on this bar. Currently, the shoot that we are getting, there is no aim. So this is not an aim and shoot. This is an aim and shoot. Aim and shoot. This. Okay. Cummins India, almost an aim, on the verge of an aim. It was 27.8. Now, in this kind of case, what should we do, sir? Should we leave it? It came very close to aim. This I leave to your judgment. If it's 30, don't consider it. If it's 26, 25 and a half or something, of course you can consider it. This is almost an aim and shoot. This is also almost an aim and shoot. This is not an aim and shoot. So like this, by creating the scanner over here, you will be able to scan hundreds of stocks in just few seconds and come down to just few of them, 4, 5, 6 of them, and then manually check yourself. Which ones do you want to go for? Which ones do you want to go for? This is called preparation. This is essentially I'm preparing, I'm finding out, I'm scouting for opportunities which I'll be looking to exercise the next day in the market. Okay. Can the entire aim and shoot be created in the technical query so that no filtration from my side is needed? Yes, it is possible. Then why are we not doing it? Because it is complex. You have just got exposed to the software. It doesn't make sense to show complexities of the software just to bog you down. Okay, it has to be step-by-step manner. To almost, I would say 95% of the aim and shoot strategy can be created in this. In such a case, the number of conditions will go more than 15, 20. It will become a little complex, and that's why I'm purposely not showing it, but it's possible. Someone who's a user of the software will be able to do it. The same thing one can do upside down for a short aim and shoot. I'm going to quickly make it here for you so that it stays recorded in this video. Later on, when you get the recordings, it will be easier for you to recreate it yourself. Average short long, exponential 13 and exponential 21. Let's say on the daily time frame. By the way, you can create on any time frame, okay? On the daily time frame. In this case, the condition will be below average for the last 10 bars. Get another average, and this time go for 21 and 34 on the daily time frame, and again below average for the last 10 bars. And this time RSI, the value of RSI, relative strength index of 3 period, should be above the value of 75. You want an overbought condition. And for the shoot, for the stochastics, you can say 432, and it has given you a cut downward, cutting average downward cut. Okay, just to make sure that only concrete setups comes up. Let's say 432, the value of percentage D is above 60. Above percentage D is 60. Add. So we've created all the 4 conditions. I come here and I type C4 and C4 and C5 and C6, C4, C5, C6, C7, 1, 2, 1, 2, 3, 4, C4, below average, RSI, okay, I'm sorry, C6 should not come. C7 will come, I'm very sorry. C7 will come and C8 will come. You can name it aim and shoot short. You can name it aim and shoot long. That's it. Select it, run. Nothing comes on short because, of course, the market's in such a situation that finding a stock which is in a downtrend is very difficult now. Let me quickly scan the 500 stocks to find any opportunities. Nothing. There's no stock which is in a down order. So when the market turns, you'll start to get them in a smaller time frames as well. Once you get the suggested trades, you check them manually to find whether there was an aim or not. This is very important. You have to have an aim, a proper, well-defined aim. Okay, and once you have an aim, next has to be a shoot based on the shoot bar, the candlestick which has given you a confirmation of a buy. You buy above the high of that confirmation candlestick. Target and exits is something we will discuss tomorrow. In fact, tomorrow I'll also show you another way in which this can be done. This exact entry of aim and shoot can also be done in another way, which is something I'm going to show you tomorrow. Okay, this is a swing trading approach. Is this the only way one can buy on a dip or sell on a rise? No, there can be umpteen different ways. You can use various other indicators. Most of them will be derived from price, but please understand what are we trying to do. The concept is most important. Number one, find a good trend. Number two, find a short-term correction of that good trend. Number three, back of our mind, there is an assumption and belief and expectation that the trend should ideally continue. Number four, once we get a sign, a signal, a confirmation of this continuation, jump on board and try to monetize it. This is the key approach of the swing trades that I prefer to do and I prefer to show and teach as well. Okay, let me quickly take a look at. Can you copy and send relevant YouTube videos like links on WhatsApp like you had sent in the first class? Okay, I'll do that today itself. Current RSI of Nifty is above 70. What to do? Nothing to do. Market's gone up. Nifty has gone above 70. If the prices go up, RSI will also go up. There is some degree of divergences on the 75-minute charts of the Nifty. You can check this in my weekly videos. Today's weekly video will be live at 8 o'clock in the evening on YouTube. You can check that. Are candle pattern basics and not actually used in trade? Good question. Now, what happens is when you find an opportunity of a trade, okay, let's say we had Bajaj Finserv, right? We had Bajaj Finserv. Now you notice here, it's like a bullish Harami pattern. Now, when you have a confluence, a combination of positivity coming from various sources, the setup becomes stronger. So if you have a prospective aim and shoot trade, and in that situation, you happen to have a positive candle, which is confirming your anticipation. This bullish Harami is confirming, is giving us the same signal like our aim and shoot, though we don't have a shoot yet, but this is making us more excited. This is making us more confident. So yes, if you get any kind of positivity, let's say if you get a positive candlestick pattern within a positive aim and shoot, of course it reinforces, it makes your system, your conviction on the trade stronger. Should we wait for that pattern? Not necessarily. Why? Because it may or may not come. If it comes, it's better. That's it. All right. RSI, it is RSI 14 used in this strategy. No, RSI 3 is used in this strategy, Srirag. If you had paid attention, then time and again I mentioned that we need to find short-term corrections, short-term momentum. And for short-term momentum, we have to use a short-term indicator. And so I had written multiple times it's RSI 3 and not RSI 14. It will be good if you check the recording of the video again later when you get it. It is RSI 3 that I've used. Can be done on TradingView, very much can be done on TradingView. So this is that Escorts chart. You come to indicators and you go to moving average exponential 1, 2, 3. And see, I have a undue advantage because I am the premium user of iGuess TradingView. So for me, there are no restrictions. So I'll be able to plot as many indicators in whichever way possible. So it's easier for me. But those who are not in any kind of paid version of TradingView, then the Zerodha platform will definitely help you. The investing platform will definitely help you because they have no such restrictions. You can plot as many indicators as you want to. Remember one thing, please pay attention. Remember one thing, the value of percentage K will be 4. The value of percentage D will be 2. Different softwares will place them differently.
It's 3 o'clock.
Smoothing will always be 3. Since Spider software, the smoothing was above percentage D. In TradingView, the smoothing factor is below percentage D. So don't go 432, 432 in all softwares. 4 attributes to percentage K, 2 attributes to percentage D, and the smoothing factor is 3. This is the look and feel on TradingView. Of course, you will not be able to create any scanners per se here. But what you can do is, if you're a visual trader, you can check if you have a limited universe of stocks. You can click on them. You can say, okay, Hindustan Unilever is in an uptrend. So if it comes down, it can give us an opportunity. I'm looking at Maruti Suzuki here, was in a nice uptrend, came down for 3-4 bars, created an aim here, and then it gave us a shoot. This was my buy opportunity. This was my stop loss. It's moving as of now. It's doing good. This is aim and shoot. Okay. Coming back after the break, we will do contrarian strategy. I call it the hook, HOOK, the hook contrarian strategy. Does a good job when the market decides to come down, but it will not do so good when it's in a strong uptrend or a strong downtrend. We will use volatility in that indicator, but before that, I need a break as always. You, of course, I'm sure need a break. So it's 3:01 heading towards 3:02. So we meet at 12 minutes will give us what? 3:14, 3:15 is a perfect time. 15 minutes past 3 o'clock, we join back and we continue with strategies with the hook contrarian strategy. Thank you. All right, so let's move ahead. I hope everyone's joined back. We are on schedule. Now what we'll do is we will look into contrarian opportunities. The contrarian setup, I call it the hook strategy. Now this is easier said than done. This is not easy. This cannot be done with the same degree of consistency as we find in swing trades. You see, in contrarian trading, the biggest hurdle, the biggest difficulty is we are trying to trade against the main flow of the market. So the chances of getting run over is very, very high, especially in the kind of markets that we are in right now, when the underlying flow of the market of buying is so strong that every attempt of selling at a high has led to losses. So the biggest hurdle for any sort of contrarian approach is against the trend. This is the issue for a contrarian trader, but they do give us decent opportunities, and at times those opportunities play off well. The risk reward of contrarian traders are better. That is, by taking a smaller risk, the possibility of earning a relatively larger return is very, very high in contrarian strategies. Easier said than done. Easier said than done. Between contrarian strategy and swing strategy and breakout strategy, I would always suggest give swing strategy a shot. Give it a try. Attempt it for a certain degree of time and number of trades to conclude yourself, so that you will be able to conclude whether it makes any sense to you or not. Breakout is not that difficult. Breakout is far more easier than the other two. Contrarian is not easy, and if you have to check out, or if you have to negate or neglect one approach, then I would say the first one that you can check out is the contrarian strategy. However, it can be done. It can be at least attempted and tried upon. So what is the hook strategy made up of? Let me show you an example. So let's come here. Let's clear all the drawings and all the indicators. And let me open the chart of Nifty. Line chart. Okay. And there are many examples, but I will take up one classic example and then we will build upon that in a step-by-step manner. So contrarian strategy means against the flow of the market. So the flow of the market over here is an uptrend. We are looking to sell the rise. Okay. So for that, an existence of a divergence is extremely important. And the concept of divergence that we have understood in our previous session when we spoke about indicators, that primarily the best form of divergence we can find with the relative strength index. Relative strength index. By default, the 14 comes. If you use 14, the number of trades will be much lesser. So for a little aggressive approach, if you want to approach it little aggressively, I suggest you can change it to a very shorter time frame, which is 3, which the same 3 that we discussed in our aim and shoot can be implemented here as well. So if you look at this juncture, prices have definitely gone up, and during that time your RSI has definitely come down. The value of RSI has come down from 97.95 to 92.27. This is an immediate divergence. Remember, you need immediate divergence, not intermediate divergence. But this is a divergence. This does not justify a hook trade. For it to be a hook trade, for it to have some more support to it, for it to have some more confirmations to it, we will bring in our shoot indicator. The shoot indicator is made up of stochastics. If you remember, some time back, we introduced the stochastics. And with the stochastics, shoot indicator was 4, 2, and 3. Okay, so what we are looking for in a hook trade, what exactly are we looking for in a hook trade is this. Number one, there has to be a immediate divergence. And when the divergence is happening, when the divergence, we can see very clearly the divergence. On that particular bar, the shoot should already be in the direction of the anticipated trade. What is your anticipated trade? Your anticipated trade is on the short side. You're looking to sell, right? Negative. So you have the negative divergence. And when you look down here, can you clearly see that the shoot has already given us a negative cross down? It has already turned negative. Now, if you turn it into a Japanese candlestick or a bar chart, this was the day. This green doji kind of a day is the candlestick which confirms the divergence, and it also happens to have a negative shoot, already a negative shoot. So the trade to be taken is to sell below the low of that candle, keep a stop loss above the high of that candle, and then tomorrow we'll talk about exits and targets. This is a hook short trade. So when it comes to hook short, we are looking for, number one, price RSI 3 negative immediate divergence. It's very important that you get the immediate divergence, not intermediate divergence. RSI 3 for large number of opportunities, RSI 14 for relatively lesser number of opportunities. And on the bar, which gives you the divergence, a negative shoot on the very bar or candle which confirms the divergence. Hook long, for a hook long trade, it's just the opposite. You will be looking for a price with RSI 3 positive immediate divergence. Again, it is very important that the divergence is immediate in nature and not intermediate in nature. Number two, positive shoot on the divergence bar. There can be an add-on to this with the help of volatility. We will look into it now. But ideally, what we are looking for is this. I can take a screenshot of this. hook shot. Divergence, shoot. Now, there can be an angle of volatility. There can be an angle of volatility to this setup as well. Let me explain this to you, then I'll come to your questions. Akhilesh got a question for me. Can RSI divergence indicator be used for this? Yes, it can be used for this, Akhilesh, provided you are sacrosanct, you're quite sure and certain that that divergence indicator is doing exactly the work that you are looking for. Don't just buy a book by its cover. If there is an indicator called RSI divergence indicator, plot it on the charts and try and figure out yourself, is it actually doing what you are seeking? Right? Many a times, most of the times you'll find it doesn't. It doesn't. So it is not always the kind of divergence that we are looking for. Give it a try. Okay. Now the angle that can be got into, that we can bring into this setup, is that of volatility through the Bollinger Bands. Okay. Bollinger Bands, let me do one thing. Let me zoom out the price. Let me clean all your drawings and let's plot the Bollinger Bands. Bollinger Bands is a useful volatility tool, which again is calculated from price. It's got a lot of angle to it. Let me explain a bit of it because it can go into quite a bit of depth, and then we'll see how we can use it as a filter. Okay, so let me take a screenshot. Let me take this screenshot. I will use this screenshot to explain the basics of Bollinger Bands, those who are completely new to the subject. There you go. So we are discussing Bollinger Bands here, okay? Named after John Bollinger, the person who has developed this indicator. It essentially tries to understand the volatility of the market from the lens, from the point of view of standard deviation. I don't want to go into too much statistics and bore you, those who are not into all this, but let's try and understand what the indicator looks like and how does it use standard deviation to figure out volatility. So if you look at the Bollinger Band, it's made up of 3 lines. Okay, this one is the middle line. This middle line is nothing but a 20 period simple moving average. A 20 period simple moving average, like a moving average. This one is the lower Bollinger Band. The lower Bollinger Band is nothing but 2 standard deviation subtracted minus 2 standard deviation from the midline. So it is 2 standard deviation minus this. Similarly, 2 standard deviation added to this gives us the upper Bollinger Band, which is addition of 2 standard deviation from the middle line. What it gives us is a band kind of a look, which is self-adjusting. If you check closely, you will find that at places, at instances, the difference between the upper Bollinger Band will be huge On the other hand, at few places, the difference between the upper Bollinger Band and the lower Bollinger Band is very, very, very shallow. So it is this difference between the two, upper Bollinger Band and the lower Bollinger Band, that to some extent visually helps us to understand the volatility of the market. The two important terms that we use here is contraction and expansion. It is natural, like breathe in, breathe out, like sunset, sunrise. When prices go up and down and behave what they do, you will always find that they contract and expand. Contraction means prices are contracted within a shallow, narrow range. There is no directional clarity. Markets and the prices are not too sure which way they want to go, so they are stuck in a range. Contraction. That is where the upper and the lower Bollinger Band comes very close to each other. They are termed as squeeze. We can also call them pinch, and there are various other terms to it. However, when eventually prices decides to rally or trend, that trend can be one way up or one way down, you will notice that these bands will just bulge out. They will just move away from each other, and their difference will be huge, large, relatively much more than before. This is expansion, an expansionary market and a contracting market, an expanded market and a contracted market. Contracted market always leads to an expanded market, and expanded market always leads to a contracted market. So if you have a contraction, you know sooner or later there is going to be an expansion. If there is already an expansion, means the market is already rallying or already going up a distance, you know sooner or later this rally will cease and the markets will contract. This is more or less what the Bollinger Band tries to do, and there are various aspects to it. But we will straight away go to that aspect of Bollinger Band which is useful to us for the hook strategy. And what is that? That is the M top and the W bottom pattern. The M top will be considered with the upper Bollinger Band. There can be three cases: case 1, case 2, case 3. In red, I have drawn the upper Bollinger Band. Now let's look at price. Prices goes outside and closes, makes a high outside the upper Bollinger Band. Next, it makes a top inside the upper Bollinger Band. First case, prices goes outside. The next case, prices comes inside the upper Bollinger Band. It makes two highs like this. The other case can be it goes outside and inside like this. And the third case will be outside and inside like this. The difference between 1, 2, and 3 is primarily the relationship between inside and outside. For example, if you notice over here, the level of outside and the inside is the same. They are more or less at the same level. If you look here, it is higher. And if you look here, it is lower. This is called an M top. And when M tops shape up, they generally, not always, of course, nothing is always, they generally try to suggest that the markets, the prices can give us a drop down, can come down at least a little bit. So when you look at this chart, this particular chart that we were looking at on the Nifty, this one. If you zoom in and notice at the behavior of the price, and remember very carefully, it has to be the closing price. You should not look at the candlesticks or the bar chart or the Heikin Nashi. In this case, you have to change it to the line chart and figure out the closing price. So now when you look at it, no, not this one, this one, yeah. So when you look at it, what do you see? You can clearly see here that in this juncture, it was outside, and in this juncture, it is inside. This is an M top, and this is the M top where the prices are going up. Now hold on for a second. If we bring back our indicators, we have a price RSI divergence, which suggests prices are relatively higher and should slow down or come down. At that very juncture, there is a negative shoot from the stochastics indicator, which also suggests that prices are likely to come down. At that very juncture, there is an M top from volatility indicator, which also suggesting the same thing. And then when you bring in the candlesticks, you also find something called very similar, not exactly, like an evening star or a doji. So when we combine all this, price alongside its momentum, price alongside its volatility indicator, and Japanese candlesticks, etc., all combined together, the odds are in your favor. The idea is to find this kind of an opportunity. Now, the mirror image for M top is W bottom. For W bottom, we will be looking at the lower Bollinger Band. And in case of the lower Bollinger Band, the prices should go outside the lower Bollinger Band and then come inside like this. Prices can go outside the lower Bollinger Band and then inside. Prices can go outside the lower Bollinger Band and then inside like this. The first one over here, this one is outside, this one is inside, this one is outside, this one is inside, this one is outside, and the next one is inside. The only difference is in their positioning. If you look here, these two are at the same level. This is higher. That is the second one, excuse me, is higher than the first one. And if you look at this one over here, this is lower. These are examples of W bottom, which suggests that there is a tendency, there can be, will be a tendency of prices to jump up, to go up. Okay. Now, out of these three cases, I have three cases for M top and I have three cases here for W bottoms. All three cases are M tops and W bottoms, all three cases. But the one that we will choose to act upon, the one that we will like to act upon, is case number 3. This one. And for M top, the case that we will be focusing upon is this one. Why? Because when the second high is higher than the first one, then only can there be a chance of a divergence. Look here. The second top, which was this, which was inside, until and unless it is higher than the first one, how can I get the divergence? I will not get the divergence. If it is, let's say it's at the same level, still okay. But if it is outside and the next one is inside and lower, then the chance of a divergence is not there. So I will not be able to act upon the divergence. So we will act upon only this part of MTOP, only this type of MTOP, and only this type of W bottom. Now, MTOP and W bottom are not necessities, they are add-ons. For long, it's a W bottom with Bollinger Band. And for short, it's an add-on, it's an MTOP with Bollinger Band. What we mean by this is having an MTOP or a W bottom is not a necessity. These are rare instances. You will not find them all the time. But if you have them, it reinforces your setup. It makes the setup more stronger. It gives us a little more edge. It probably adds the odd to be in your favor. Right? So, contrarian strategy, what you have to do is look for a stock which is, let's say, in an uptrend. This is ITC. Let's say, can we try and find this in the 15-minute chart of ITC? 15-minute would be too much. Let's stick to daily. Daily is the best time frame, by no means, by all means, that is. Okay, now see here where I've kept my cursor. This was the chart of ITC when it was bottoming out, when it was finally making a bottom. Can we clearly see the price making a lower low on a closing basis? Can we clearly see during that time the RSI has improved? Can we clearly see that shoot has already improved? It's positive. So essentially, when you're looking at it, this is the area which is suggesting that prices should bounce back. When the bounce back comes, generally you will notice that the bounce back will take you close to the average. And if the bounce back is strong enough, it will take you to the other end of the Bollinger Band. From the lower edge, it will try to go to the mid, and from the mid, it will try to go to the next. Now you'll notice here, if I turn it into a line chart, there was no W bottom. Both the lines were outside. And that's why I say that these are add-ons. These are not necessities. Do not always look for an MTOP or W bottom for a hook. For a hook, all that we need is a divergence with shoot. If it has the support of a W bottom or an MTOP, it is better. It is stronger. So need not necessarily have it. All that you will be looking for is something like this. Now, when I look at this part, let me see, this closing price is 154. Sorry. This is 146, 147. So this is higher. So remove my drawings. So like this, they will not shape up all the time. Let's see if we get a strategy, a setup here. Now see here, over here, you got a higher high. Over here, you got a lower, so you got a divergence. Wonderful. On this very bar, you do not have the negative shoot. You don't have the negative shoot. But on this bar, you got an MTOP. Now wait a minute. If you come to this part, you have the divergence, you have the MTOP, but you don't have the support of number 2. What should you do? Let's turn it into a Japanese candlestick chart. So when you turn it into a Japanese candlestick chart the next day, which is this red day, it forms almost like an engulfing. This is called a dark cloud cover. So all of a sudden, I don't have the support of shoot. But then the next day when the shoot came, on this day, when the shoot came, it got reinforced with the help of a negative candlestick pattern. So we got a next nice move. Nice move took us close to the middle band, but it was not strong enough to take us down. So you will find this, those who trades, those who are in the market for some degree of time, you will figure out that no two trades are the same. Even if you are trading the same Nifty, no two trades will be the same. they will have some here and there differences. Look at this tiny, beautiful low on the closing price, higher, and does it have the support of shoot? Yes, indeed. This one, this day. Buy above this, straight away for 1 day, 2 days, 3 days, it's done. It did not have any W bottom. So you will get permutation combination. It did not have a W bottom. Both of them are inside. This was outside, this was inside. This was outside, this was inside, but they don't have a divergence. 11 and 8, they don't have a divergence. Without the divergence, we can't trade. So you'll notice that essentially between these 3 pointers in a hook setup, the most important is the first one, which is we have to have a divergence. And with the divergence, we need a support of the shoot and maybe the occurrence of an M top or a W bottom. However, there will be examples where M top and W bottom is there, but the shoot is not there. And this is where you as a trader comes into play. Your experience comes into play, your risk-taking ability comes into play, but you get the picture. The picture is we are looking for a situation in the market where prices are in a rally mode, and it is creating us, it's giving us an opportunity. Like say again, we have a situation here. It's giving us an opportunity for a contrarian trade. Easier said than done. I'll repeat again. Swing, you will find it far more easier. But contrarian would require some degree of expertise. But this is essentially what you'll be looking for. Is this the only way to do contrarian trades? Of course not. Of course not. There'll be many ways in which it can be done. But this is just one of the ways which I have figured out is simple, is one of the ways in which I can explain it to you over a session. It's not extremely complex. It does not require too much knowing of the subject. And it's tradable. Now, I will take this opportunity to share with you something. And this is important for me to tell you. In my YouTube channel, if you've spent some time, there's a playlist called Mentorship Success, Trader Success. This is the community that I have, okay? Now in this, you will find a lot of videos of community members. Let's say this person who lives in Singapore, or this guy who lives in here in West Bengal, in Calcutta. If you listen to his video, he is an outright 15-minute aim and shoot trader, fully. This Zerodha 60-day challenge winner, this guy, is a 15-minute aim and shoot trader. Nothing, no other strategy, no other time frame. He's doing all right. He's doing pretty good. You come to the last video that we posted, this Shraddha who's from Mohali. She is also mentioning the fact that she is only trading the daily charts, I believe, and aim and shoot, swing strategy. In this video, you'll hear from him that Anupam says that he has tweaked the aim and shoot in his favor a little bit. He has made mild changes to it. Okay. And then when you listen to this guy, he's Aman, he's a CA. He's an outright contrarian trader. He does not do any breakout, any swing at all. He's completely 100% contrarian. In fact, Ankit's trades are also contrarian. Why am I telling you this? Why am I showing you this? This is nothing to boost or brag about. This is primarily to tell you, to explain you that no strategies are good or bad. They all work, they all fail. It's just that whether the strategy syncs with your style of trading, your attitude, your philosophy, your mentality, your risk-taking capabilities, your beliefs. So for one person, it fits in well. For the other person, it doesn't. And I have seen this happen over and over again so many times that it's very clear that none of the strategies are good. None of them are bad. It's just that whether we are able to apply them, and we'll be able to apply them the best when we believe in them, and we will only believe in those which are in sync with our nature. So are you a swing trader, or are you a contrarian trader, or are you a breakout trader? If you don't know, the best way to know is test and try, or try and test it out. Try it out for some time and have a feel for it. Try and understand, does this feels good? Do you want to actually do a contrarian trade? You understand what I'm saying? When you do it, you'll feel that, you'll have that sense. Few traders love to sell a rising market. That's their nature. Few traders will not even touch a rising market. Few traders will jump into a rising market and buy. None of them are doing a wrong thing. None of them are also doing the right thing. They're doing what they believe in. They believe the price will go up, that's why they're buying. They believe the price will fall, that's why they're selling. So both of them are wrong. So please understand this basic core truth, fact. And then over a period of time, slowly you'll figure out your edge, your style. And once you figure it out, all that is, rest of it is needed is just practice. That's it. I'll take up your questions. Abhishek, in aim and shoot, any other specific indicator or strategy apply? No, as of now, no. Can Spider software help in this? Should we buy above SMA or more confirmation in W bottom? See, W bottom is something that you will not get all the time. W bottom is something that you will not get all the time. Okay. Neither will be M top will be there all the time. So it's better that first and foremost thing that you look for, Aditya, will be the divergence. Then you look, see, you found the divergence. What is this? What is the logic? I found a divergence. Now, is this divergence going to work or fail? Fine. So in this divergence, is there any supporting evidence from something else? That is the logic. Is this divergence supported by a M top or W bottom? Is this divergence supported by the shoot? That's the stochastics. Is this divergence supported by a candlestick pattern? That is the logic, right? After the strategy explanation, please check Balkrishna Industries whether it belongs to the example of aim and shoot strategy. Okay, we'll take a look at it. So Balkrishna Industries fell below. So we have the Bollinger Band here. I will hide it. I don't have the triple moving averages. I'll quickly bring it on because the question is related to aim and shoot. So 1, 2, 3. So Balkrishna Industries at the current juncture cannot be an aim and shoot. Number one, it does not have a well-defined trend. It used to have a well-defined trend down here where you got an aim. After that, you got a shoot here on this bar, which was this bar. So the trade was to buy above this high with the low as a stop loss. It went above 3 days, it consolidated. It gave us a 2-day, 3-day move. Now you should be long in Balkrishna Industries. Ideally, you are in profits. At the current juncture, there is no aim and shoot. I'm sorry. There is no well-defined uptrend or downtrend, and we cannot consider this an aim and shoot. Okay. Would you like to explain more on standard deviation? How many successful strategies on we derive from? So standard deviation to standard deviation essentially statistically means that let me show it to you. When you are looking at 2 standard deviation, you notice that most of the time majority of the closing prices are inside the upper band and lower band. Rarely, in few instances, it does go outside the band. The times when it goes outside the band is very, very less compared to the times when it is inside the band. Agree? Visually we can see this. Now, statistically, 95 to 96% of the times means if we are looking at 100 closing prices, out of that 95, almost 95 closing prices should be within the upper and lower band. Only 5 times it should go outside. It ideally should go outside. In stock market, it is not just any random data. There's emotions and sentiment attached to it. So in stock market, it is not 95%. It's around 89 to 90%. What does this mean? It means that if you look at 100 closing prices of any stock chosen randomly, and you'll find that out of that 100 closing prices, 90 of them will be inside the upper and lower Bollinger Band. Only 10 times will it go outside. Right? This is the approach which Bollinger took, John Bollinger took to take up standard deviation to figure out the underlying volatility. There's a wonderful book he has written, John Bollinger on Bollinger Bands. Bollinger on Bollinger Bands. Let me show it to you. Bollinger on Bollinger Bands. This one. In this book, he details about Bollinger Bands. He takes it to a lot of other levels. But he is one guy who only bases out his entire analysis based on these bands, right? So does it work? Yes, it works. Does it fail? Of course it fails. So with a certain degree of understanding and practice, will someone get better at it? Much better at it. Okay. So here is my suggestion. When we meet tomorrow, I will do a revision of these two strategies. I walk you through. Then I will show you another way in which you can enter the trade, trail the stop losses, both together. I will bring in a breakout aspect, a breakout angle to swing trading. This will help us to ride trends. This will help us to trail stop losses. This will also be a breakout strategy in itself. Number one. Number two, then we will take it forward and go into money management. That now that we know, now that we feel that Bajaj Finserv can go up, or now that we feel that this stock can come down, how much quantity should we buy or sell? And then finally, we'll talk about traders' mentality. Srirag is asking about HDFC for a hook. Let's take a look at that. What I would suggest before we meet tomorrow, or in fact before Thursday's session. Okay, see, this is what happens. I'm typing hook HDFC. So before we go to especially Tuesday's session, it's important that you get these concepts cleared as much as possible. Now, this cannot be a hook. This is not a hook, because when you look at the two successive highs, there is no divergence. You cannot compare with this and this. These two are not comparable because there's a high here. Okay, so you need an eye for a detail over here. This is another high. This is one high. This was the next high, and this is a new high. These two highs are not creating a divergence. These two highs are creating the divergence, but these two highs are not immediate in nature. They are intermediate in nature. These two highs were immediate in nature. These two highs created a divergence. These two highs did not create a negative shoot, but they had a, what did they have? An M top. It led to a fall.
It's 4 o'clock.
Close to the average. So as I said, there'll be various different types of combinations that you will find. Would like to remind you to kindly send the notes of this class. Of course, I will send you the notes of this class once I conclude this session. So this is where I will end today. Is when we meet tomorrow, we'll do a quick revision and we'll take up the breakout angle within the swing strategy to decide upon entry, stop loss, and trailing the stop loss. Very important is trailing the stop loss. Then we'll look into money management, and then we'll look into how to set up targets based on money management, how to decide on quantity based on money management, and then trading strategies. Before we meet on Tuesday for the live session, we have a live session on Tuesday, 1.5 hours in the morning and 1.5 hours in the afternoon, market opening and market close. It will be really good if you can spend as much of your resources in these few days, next few days, and get a good hands-on understanding of these concepts. All right. Okay, so with this, I'm signing off today, Saturday, done. We meet again on Sunday, tomorrow, 1:30 p.m. Thank you everyone for your participation. God bless. Take care.